Every morning, millions of traders wake up and log into their accounts with the same burning question: how can I turn this small balance into something life-changing? They stare at charts, hunting for the perfect setup, the golden opportunity that will finally prove they have what it takes. But here's the contradiction that destroys most trading careers before they even begin. The very chemical in your brain that motivates you to trade is the same one that sabotages your discipline, ruins your consistency, and keeps you trapped in cycles of hope and despair. You think you're fighting the market, but you're actually fighting your own neurology. And until you understand this invisible enemy, every strategy you learn, every indicator you master, every piece of advice you follow will eventually crumble under the weight of your own biology. Most traders never realize they're not just competing against other market participants. They're competing against millions of years of evolutionary programming designed to seek immediate rewards and avoid immediate pain. Your brain doesn't care about your trading plan. It doesn't respect your risk management rules. It only cares about the next dopamine hit, the next surge of neurochemical satisfaction that comes from being right, from making money, from feeling like you've conquered the market. This is why intelligent people, successful professionals, even those who excel in other high-pressure careers, can become completely irrational when they start trading. The market exposes something primal in human nature, something that bypasses logic and goes straight to the reward centers of your brain. And once those pathways are activated, discipline becomes nearly impossible to maintain. Think about your own experience for a moment. Remember the last time you had a winning trade. Not just any trade, but one that really moved in your favor quickly. Do you remember that feeling? The rush, the excitement, the sense of validation. Your brain flooded with dopamine, the same neurotransmitter that's released when you eat your favorite food, when you receive unexpected good news, when you experience any form of pleasure or reward. But here's what you probably didn't realize in that moment. Your brain wasn't just celebrating your success. It was learning. It was forming neural pathways that associated trading with reward. It was conditioning you to seek that feeling again. And every time you place a trade after that, part of your motivation isn't coming from careful analysis or strategic thinking. It's coming from the unconscious desire to recreate that neurochemical high. This is where the illusion of speed begins to take hold. Your brain starts to believe that more trading equals more opportunities for reward, that faster decisions lead to faster profits, that if one trade felt good, then 10 trades will feel 10 times better. The market becomes a slot machine, and you become conditioned to pull the lever over and over, chasing the next payout. But the market operates on what psychologists call a variable reward schedule. This is the most addictive form of reinforcement known to behavioral science. Unlike a salary that pays you the same amount every 2 weeks, or a vending machine that gives you a snack every time you insert the right coins, the market rewards you unpredictably. Sometimes you win immediately. Sometimes you lose several trades in a row before hitting a winner. Sometimes you break even for weeks. This unpredictability doesn't discourage your brain. It amplifies the addiction. Because when rewards come at random intervals, the anticipation itself becomes rewarding. Your brain starts releasing dopamine not just when you win, but when you're waiting to see if you'll win. Every time you place a trade, every time the price moves in your direction, every time you think you might be about to profit, your reward system activates. Casinos have built billion-dollar empires on this principle. The flashing lights, the spinning wheels, the card reveals are all designed to trigger dopamine release during the anticipation phase, not just during wins. And whether casino operators realize it or not, they've created the perfect environment to exploit human neurobiology. The trading world, especially with modern technology, has accidentally recreated many of the same conditions. Real-time price feeds give you constant stimulation. Instant execution means immediate gratification or immediate disappointment. Mobile apps let you trade from anywhere, at any time, removing the natural barriers that might otherwise force you to pause and think. Your brain interprets this environment as a hunting ground rich with potential rewards. And just like our ancestors who had to remain alert and ready to pursue prey whenever it appeared, your modern brain becomes hyper-vigilant around trading opportunities. You start checking prices obsessively. You feel anxious when you're not in a position. You convince yourself that every small market movement might be the beginning of the big move you've been waiting for. This is when the dopamine trap fully activates. You're no longer trading because your analysis suggests a high probability setup. You're trading because your brain is demanding its next chemical reward. The decision-making process shifts from the prefrontal cortex, where logic and planning occur, to the limbic system, where emotions and impulses dominate. When you're caught in this neurochemical loop, several predictable patterns emerge. You start overtrading, taking positions that don't meet your original criteria just because the urge to be active feels overwhelming. You begin abandoning your risk management rules, increasing position sizes because larger potential rewards trigger stronger dopamine responses. You develop an inability to sit in cash, even when market conditions clearly favor patience over action. Most destructively, you lose the ability to accept small losses gracefully. Because every loss doesn't just cost you money, it denies your brain the dopamine hit it was expecting. This creates what neuroscientists call a negative prediction error. Your brain predicted a reward based on past patterns, and when that reward doesn't materialize, dopamine levels actually drop below baseline. You don't just feel disappointed. You feel worse than if you'd never traded at all. This neurochemical crash triggers an almost irresistible urge to immediately place another trade, not because you've identified a new opportunity, but because your brain is desperate to return dopamine levels to normal. You enter what traders call revenge mode, but what's really happening is that you're medicating a neurochemical imbalance with more market activity. The cruel irony is that this pattern typically leads to larger losses, which create even deeper dopamine crashes, which trigger even more desperate attempts at recovery. Many traders find themselves in spirals where they know intellectually that they should stop, but they feel emotionally compelled to continue. They're not being stubborn or reckless, they're experiencing a form of neurological hijacking. Understanding this process is the first step toward breaking free from it, because once you recognize that your urges to overtrade, to chase losses, to abandon your plan aren't character flaws, but predictable biological responses, you can begin to develop strategies that work with your neurology instead of against it. The most successful traders throughout history weren't necessarily the smartest or the most analytical. They were the ones who learned to master their own reward systems. They developed mental frameworks that generated satisfaction from discipline itself, rather than from immediate market results. They found ways to redirect their dopamine-seeking behavior toward long-term consistency, rather than short-term excitement. This transformation doesn't happen overnight. Your brain has spent years, maybe decades, learning to associate quick decisions with potential rewards. These neural pathways are well-established, deeply ingrained patterns that resist change. But the human brain also possesses a remarkable quality called neuroplasticity. With the right approach and sufficient repetition, you can literally rewire your mental circuitry. The question isn't whether you're capable of developing trading discipline. The question is whether you're willing to acknowledge that discipline isn't about willpower or character strength. It's about understanding and redirecting the fundamental drives that motivate human behavior. Once you accept that your biggest enemy isn't market volatility or economic uncertainty, but your own dopamine system, you can begin the real work of transformation. Real work of transformation. The science behind this transformation reveals something profound about human potential. When you repeatedly choose discipline over impulse, when you consistently follow your rules despite the emotional pull to deviate, you're not just becoming a better trader, you're literally reshaping the architecture of your mind. Neuroplasticity researchers have discovered that the brain remains malleable throughout life. Every time you resist the urge to overtrade, every moment you choose patience over action, you strengthen neural pathways associated with self-control. Meanwhile, the circuits that drove impulsive behavior begin to weaken through disuse. But here's what makes this process so challenging. Your old patterns don't disappear quietly. They fight back with increasing intensity before they fade. This is why many traders experience what feels like withdrawal when they first attempt to trade with discipline. The dopamine system, accustomed to frequent stimulation, creates powerful cravings for market activity. You might find yourself obsessively checking charts even when no valid setups exist. Your hands might literally itch to place trades. Your mind might manufacture urgent reasons why this particular moment requires immediate action. These aren't signs of weakness. They're evidence that your brain is undergoing fundamental rewiring. The traders who survive this neurological rebellion understand that discomfort is temporary, but the patterns they're building are permanent. They recognize that every moment of resisted temptation makes the next moment of resistance slightly easier. They're not just learning to trade differently, they're becoming different people. Consider the paradox of modern trading technology. Platforms designed to provide convenience and speed have inadvertently created the perfect environment for dopamine addiction. One-click execution removes the natural pause that might allow rational thought to intervene. Real-time profit and loss displays provide constant emotional stimulation. Push notifications ensure that market movements interrupt your attention throughout the day. Your smartphone transforms into a portable casino, available 24 hours a day. Unlike traditional gambling, where you must physically travel to a specific location, trading apps eliminate every barrier between impulse and action. The moment you feel the urge to trade, satisfaction is literally at your fingertips. This technological acceleration conflicts directly with the time horizons required for sustainable profitability. Markets move in cycles measured in weeks, months, and years. But your dopamine system responds to stimulation measured in seconds and minutes. The mismatch between biological reward timing and market reality creates a fundamental tension that destroys most trading careers. Professional traders develop strategies to reintroduce friction into their decision-making process. They might require themselves to write down 3 reasons for entering any trade before execution. They could implement cooling-off periods between trades, forcing themselves to wait at least 30 minutes before placing another order. Some even physically distance themselves from their trading setup, making impulsive actions literally impossible. These aren't arbitrary rules designed to make trading more difficult. They're neurological circuit breakers that give the prefrontal cortex time to override limbic system impulses. They create space for rational thought in an environment specifically designed to eliminate such space. The most insidious aspect of dopamine-driven trading is how it masquerades as analytical activity. You convince yourself that constantly monitoring price action is research, that adjusting stop losses and profit targets throughout the day represents active management, that checking multiple timeframes obsessively constitutes thorough analysis. But genuine analysis happens before you enter positions, not after. Once you're in a trade, additional screen time typically serves emotional needs rather than strategic ones. You're not gathering information, you're seeking stimulation or reassurance. This distinction becomes clearer when you examine how your behavior changes between winning and losing streaks. During profitable periods, you might check your account balance frequently, savoring the positive numbers. You refresh your profit and loss statements, screenshot favorable results, perhaps even share your success on social media. This isn't strategic behavior, it's dopamine-seeking behavior disguised as professional activity. During losing streaks, the compulsion intensifies, but changes character. You might avoid looking at your total account balance while obsessively monitoring individual position performance. You rationalize holding losing trades longer than your plan specified, hoping for reversals that would restore both your account balance and your dopamine levels to comfortable ranges. Both patterns reveal the same underlying dynamic. Your relationship with trading has shifted from strategic to emotional. You're no longer executing a business plan, you're managing a neurochemical dependency. Breaking free requires recognizing that sustainable profitability comes from being selectively active, not constantly engaged. The most successful traders spend more time waiting than acting. They understand that perfect setups are rare, and patience is the price of accessing them. This waiting isn't passive, it's intensely active mental training. Every moment you choose not to trade when conditions don't meet your criteria, you're strengthening your ability to recognize and act only on genuine opportunities. You're conditioning your brain to find satisfaction in discipline itself rather than in market activity. The transformation begins when you redefine what constitutes a successful trading day. Instead of measuring success by profits earned or trades completed, you measure it by rules followed and discipline maintained. A day where you took no trades because no valid setups appeared becomes a victory, not a missed opportunity. This mental shift requires rewiring your reward system at the most fundamental level. You must learn to derive dopamine from process adherence rather than outcome achievement. The satisfaction comes not from being right about market direction, but from executing your methodology flawlessly regardless of results. Think about how this applies to position sizing. Your dopamine system pushes you toward larger trades because bigger potential rewards trigger stronger neurochemical responses. But professional risk management requires position sizes that feel almost insignificantly small relative to your account balance. The amateur trader risks 5 or 10% of their capital per trade because anything less feels emotionally unsatisfying. The professional risks 1 or 2% because they understand that sustainable wealth comes from surviving inevitable losing streaks, not from maximizing individual trade profits. This isn't just a difference in risk tolerance, it's a difference in neurological conditioning. The professional has trained their brain to find satisfaction in methodical capital preservation rather than in the excitement of large potential gains. Consider how this principle extends to trade duration. Day trading appeals to many beginners because it provides constant stimulation and frequent opportunities for dopamine release. Every few minutes brings new price action, new decisions, new chances for quick profits or losses. But the most successful wealth builders in financial history typically held positions for months or years. They found ways to derive satisfaction from patient capital appreciation rather than from frequent transaction activity. Their dopamine systems became calibrated to longer-term thinking and delayed gratification. This doesn't mean day trading is impossible or inherently flawed. It means that successful short-term trading requires even more sophisticated emotional regulation because you're working against stronger neurological currents. You must develop the ability to remain calm and systematic in an environment specifically designed to trigger impulsive responses. The market's constant motion creates an illusion of urgency that doesn't actually exist. Price movements that feel critically important in real time often prove completely irrelevant when viewed from longer-term perspectives. But your dopamine system responds to immediate stimulation, not to eventual significance. Learning to distinguish between genuine opportunities and neurochemical noise becomes a crucial skill. Most market movements represent random fluctuation around underlying trends, but your brain interprets every tick as potentially meaningful because it's wired to detect patterns even where none exist. This pattern recognition system served our ancestors well when identifying potential threats or opportunities in natural environments. But financial markets contain so much random data that the same system generates countless false signals. Your brain sees setups everywhere because it's evolutionarily programmed to err on the side of caution rather than miss potentially important information. Professional traders develop filtering mechanisms that help them ignore the majority of market noise. They might only trade during specific hours when volatility patterns favor their strategies. They could focus exclusively on particular instruments that they understand deeply rather than spreading attention across multiple markets. These constraints aren't limitations. They're focusing devices that help channel neurological tendencies toward productive outcomes. By deliberately narrowing their scope of attention, successful traders reduce the number of dopamine-triggering stimuli they encounter, while increasing the quality of opportunities they pursue. The path forward requires acknowledging that your brain will never stop seeking rewards. The goal isn't to eliminate dopamine responses, but to redirect them toward behaviors that support long-term success rather than short-term gratification. This means finding ways to make discipline itself rewarding. You might track and celebrate metrics like the percentage of trades that followed your complete methodology, or the number of days you successfully avoided overtrading, or the consistency of your position sizing over time. These process-focused rewards help retrain your neurochemical system to find satisfaction in the activities that actually drive sustainable profitability, rather than in the outcomes that feel immediately gratifying but often prove counterproductive over longer time frames. The transformation isn't about becoming emotionless or mechanical. It's about becoming selective about which emotions you allow to influence your decisions. Fear and greed will always arise in response to market movements, but they don't have to dictate your actions. Professional traders feel the same emotional impulses as amateurs. They experience the same dopamine surges during winning trades and the same neurochemical crashes during losses. The difference lies not in the absence of these responses, but in their ability to observe them without being controlled by them. This observational capacity develops through practice. Each time you notice an emotional impulse arising and choose not to act on it immediately, you strengthen your ability to maintain perspective during future emotional storms. You're training your prefrontal cortex to maintain executive control, even when your limbic system is highly activated. The process requires patience with yourself as much as patience with the markets. Neurological rewiring doesn't happen overnight. You'll experience setbacks where old patterns reassert themselves despite your best intentions. These lapses aren't failures, they're part of the natural learning process. What matters is your response to these moments. Do you use them as evidence that discipline is impossible, or as data about which situations trigger your strongest emotional responses? The traders who eventually achieve consistency Treat every mistake as valuable information rather than as proof of inadequacy. Your relationship with trading will fundamentally change as this transformation progresses. Activities that once felt exciting will begin to feel routine. Outcomes that used to trigger strong emotional responses will seem like natural fluctuations in an ongoing process. This isn't numbness or indifference. It's the calm confidence that comes from understanding probability, accepting uncertainty, and trusting in methodical execution over time. You'll still feel satisfaction from successful trades, but it will be the quiet satisfaction of a craftsperson executing their skill rather than the intense rush of a gambler hitting a jackpot. The market will continue testing your resolve with perfect setups that fail, obvious opportunities that reverse unexpectedly, and prolonged periods where nothing seems to work according to plan. But your neurological foundation will have shifted from seeking validation through market results to finding purpose in consistent execution of sound principles. This shift represents more than just improved trading performance. It's a fundamental rewiring of how you relate to uncertainty, delayed gratification, and the gap between effort and outcome. These lessons extend far beyond financial markets into every area of life, where discipline and patience determine long-term success. The neural pathways that drive this behavior run deeper than most traders realize. Your brain doesn't distinguish between the excitement of a winning trade and the rush of any other rewarding experience. Whether it's checking social media notifications, eating your favorite dessert, or hitting a jackpot on a slot machine, the same neurochemical mechanisms activate. The same reward circuits fire, the same craving for repetition emerges. This is why trading can feel so consuming, so all-encompassing that it invades your thoughts even when the markets are closed. Your brain has learned to associate the act of trading with the possibility of reward, and that association grows stronger with every market session. The problem isn't that you lack willpower or intelligence. The problem is that you're fighting against millions of years of evolutionary programming with nothing but conscious intention. Think about the last time you told yourself you'd only check the charts for a few minutes, just to see what the market was doing. 4 hours later, you're still glued to the screen, having placed multiple trades that weren't part of your original plan. Your rational mind knew you should step away, but your dopamine system had other priorities. It kept feeding you small doses of stimulation through price movements, near misses, and the constant possibility that the next candlestick might reveal the perfect setup. This hijacking of attention represents one of the most underestimated challenges in modern trading. Your brain interprets the constant stream of market data as a hunting environment, rich with potential rewards. Every uptick in price becomes a signal that prey might be near. Every downtick suggests that danger or opportunity is approaching. Your nervous system remains in a state of hypervigilance that would have been appropriate for our ancestors tracking animals across the savannah, but which becomes exhausting and counterproductive in financial markets. The exhaustion isn't just mental, it's neurochemical. When dopamine levels spike repeatedly throughout a trading session, your brain eventually depletes its natural reserves. You begin to feel foggy, irritable, and unable to think clearly. But instead of recognizing this as a signal to rest, most traders interpret it as a sign that they're not trying hard enough. They push through the fatigue, making increasingly poor decisions as their neurological resources become depleted. Professional traders understand that mental energy is a finite resource that must be managed strategically. They don't trade when they're tired, stressed, or emotionally compromised, because they know these states make disciplined execution nearly impossible. They treat their psychological condition with the same respect that athletes show toward their physical conditioning. This awareness extends to understanding how different market conditions affect your neurochemical state. High volatility environments create more frequent dopamine spikes, leading to faster depletion of mental resources. Trending markets provide steady reinforcement that can lull you into overconfidence. Choppy sideways markets frustrate your pattern-seeking brain and can trigger increasingly desperate attempts to find profitable opportunities when none exist. The most successful traders learn to calibrate their approach to match both their internal state and external market conditions. They might reduce position sizes when they notice their attention becoming scattered. They could limit their trading hours during particularly volatile periods to prevent neurochemical overload. They understand that sustainable performance comes from working with their biology rather than against it. But here's where the story becomes more complex. The same dopamine system that creates these challenges also powers your ability to learn, adapt, and improve. Dopamine isn't inherently good or bad. It's simply a neurochemical messenger that your brain uses to reinforce behaviors that it perceives as beneficial for survival. The key is learning to direct this system toward activities that actually support your long-term trading success. This redirection requires understanding the difference between immediate gratification and delayed satisfaction. Your dopamine system evolved to prioritize immediate rewards because, in ancestral environments, delayed rewards often never materialized. If you found food, you ate it immediately rather than saving it for later because later might never come. If you encountered a potential mate, you pursued that opportunity immediately rather than waiting for a better option. But financial markets operate on completely different time horizons. The setups that produce the most consistent profits often require waiting days, weeks, or even months for optimal entry points. The position sizes that preserve capital during inevitable losing streaks feel insignificantly small compared to what your reward system craves. The risk management rules that ensure long-term survival frequently prevent you from maximizing individual trade profits. This mismatch between evolutionary programming and market reality creates constant internal tension. Part of your brain is always pushing for more immediate, more exciting, more stimulating trading activity. Another part knows that patience and discipline are essential for long-term success. Most traders never resolve this conflict. They oscillate between periods of rigid discipline and episodes of complete emotional abandon, never finding a sustainable middle ground. The resolution comes through recognizing that discipline itself can become a source of dopamine release. When you successfully follow your trading rules despite strong emotional impulses to deviate, your brain can learn to interpret that adherence as a victory worthy of neurochemical reward. But this learning process requires conscious effort and consistent repetition. You must begin celebrating process victories with the same intensity that you naturally celebrate outcome victories. The day you take only 2 high-quality trades instead of 10 mediocre ones becomes a triumph worth acknowledging. The week you maintain consistent position sizing, despite several losing trades, becomes evidence of professional growth. The month you stick to your predetermined trading schedule without deviation becomes a milestone in your development as a trader. This reframing isn't just positive thinking or motivational psychology, it's practical neuroscience. Your brain learns through repetition and reinforcement. If you consistently associate disciplined behavior with positive emotions, those neural pathways strengthen. If you only celebrate financial outcomes while ignoring process improvements, you inadvertently train your brain to prioritize results over methodology. The transformation becomes more profound when you realize that trading discipline extends far beyond market activities. The patience you develop while waiting for perfect setups improves your ability to delay gratification in other areas of life. The emotional regulation you cultivate while managing losing streaks enhances your resilience during any type of adversity. The systematic thinking you apply to risk management sharpens your decision-making in countless other contexts. This is why some of the most successful traders describe their craft as a form of personal development disguised as a financial activity. The market becomes a mirror that reflects your deepest psychological patterns, forcing you to confront aspects of yourself that might otherwise remain hidden. Every trade tests your ability to remain calm under pressure, to think clearly despite uncertainty, and to act according to principle rather than impulse. The traders who thrive are those who embrace this mirror rather than fighting against it. They use market feedback to identify their psychological blind spots and systematically address them. They view losses not as financial setbacks, but as tuition payments for lessons in emotional mastery. They understand that becoming consistently profitable requires becoming a different type of person, one whose default responses align with long-term success rather than short-term comfort. Your brain will always seek dopamine. That's not going to change. But you can choose what triggers that release. The traders who build lasting wealth learn to find satisfaction in the process itself, not just the profits. They celebrate discipline. They find joy in patience. They derive meaning from consistency. This isn't about fighting your biology. It's about redirecting it toward behaviors that actually serve your long-term success.